Well, hi there, everyone. Happy Tuesday, July 8th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautiful and quite warm Redmond, Washington. Good to have you here on the show, and thanks so much for joining me. We're back after a vacation week last week, and awesome to get back in the swing. Also, a little exhausting. I was enjoying a week of having fun, chilling with family, and not thinking about work for a bit. The good news is I really enjoy doing this, and I hope you enjoy the show. The fact that you're watching it, hopefully, is a signal that you're finding joy in it as well, and that brings me some happiness for sure. We're going to talk about the market conditions today. Very much a choppy session. At the end of the day, directionally, not a lot happening in terms of the major indexes. However, quite a few movements when we go that next level down. We're going to talk about the breadth conditions today. And we're going to talk about some of the changes in breadth we've observed here going into this week. We'll talk about a big spike higher in energy stocks, despite crude oil kind of being okay. Big move in energy, and a number of those energy stocks started to pop higher. A lot of charts to review, a couple different indicators that I've been toying around with that I'd like to share with you as well. With that in mind, let's get to the market recap. As a reminder, I can see questions and comments that are coming in on any of the platforms upon which we're live streaming. So if you're tuning in live, welcome, and thanks for doing so. We're on Facebook, LinkedIn, X, and YouTube. So if you follow me on those different platforms, you'll be able to see the market recap every day when we live stream it at 5 p.m. Eastern. Put questions as we go through the market review, go through the heat map, go through the charts. At the end of the show, I'll take a question or two before we wrap for the day. Any of the questions we don't get to, we'll put them in the Chart This mailbag for Friday's episode, where we'll spend time answering questions we've received during the week. Always a lot of fun. Hope I can answer one of your questions as part of that exercise. This is what I was talking about. This was yesterday, right, with the higher open and lower close, right? So distributing through the course of the day. That's coming after Thursday's, most recent all-time high for the on the shortened holiday session. Today, we're sort of chopping around here. The market at an equilibrium, kind of pivoting around yesterday's close, which is around 62.30. You can see we spent about half the day above, half of the day below. We're a stone's throw away from yesterday's close here, with the S&P closing just about 62.25. That's less than 0.1% below yesterday's close. The NASDAQ unchanged as well. The Dow slightly lower, mid-cap, small-cap slightly higher. And the small cap indexes did the best. The S&P 600 ended up being up about 0.8%. It's not a big move when you look at the major indexes. That sort of choppy but directionally agnostic market move means volatility has come down. The VIX ended the day just below 17, so we're still in a low volatility environment. I have a perpetual alert for if and when the VIX pops above 20. That is my warning sign that things may be starting to get hairy. Why do I look at that? To be quite honest with you, I've never seen the market have any significant sell-off without volatility spiking, right? It's just the nature of how markets move up and markets move down. They tend to gradually go up as investors accumulate shares. They tend to sell off much more quickly. The volatility tends to increase when people are motivated more by fear as opposed to greed, I guess, is the way you would describe it during the uptrends. So as a result, spikes in volatility are one of those great red flags that things might start to pivot. In this environment, with the S&P, making new all-time highs in the last week, with the breadth conditions overall being quite strong, with the trends being pretty consistently positive on any time frame I would look at, you're just looking for signs of weakness. You're looking for signs that the uptrend is starting to slow down. You're looking for signs of exhaustion. You're looking for signs that conditions which have looked very good are no longer looking good from a technical perspective. Spike in volatility, one of those things. Not seeing it yet. We're still with the VIX well below 20, but keep an eye on that for sure. We'll keep you updated every day as we do the recap for that moment when that starts to happen. Bonds sold off a bit today. Again, opened a lot lower, but actually rallied higher through the afternoon. But it still ended up slightly lower. So the TLT finished slightly in the red. That means interest rates generally moved higher. We can see the 10-year points around 4.4%. Long bonds still just around 4.95, and the 5-year point just below 4%. The dollar index, really not much of a change from yesterday. So overall, this is sort of a wait and see mode. We've talked about how the market's sort of in limbo, waiting for some sort of clarity on tariffs. It certainly seems to me like this week is a lot of noise and talk about tariffs, but no real specifics. It's all still speculation. That's going to be the case for quite some time, I feel like, until we get some sort of closure, if that's something we'll ever get on tariffs. For now, we've now pushed out the deadline into early August. I think earnings coming up starting next week is when we'll start to get a lot more discussion about tariffs and the potential impacts, right? The ripple effects of these proposed tariffs or anticipated tariffs, and how that relates to companies' ability to grow earnings, which is what we're really focused on as equity investors. So we'll see more to come in the weeks going forward. Gold slightly lower today, had a big sell-off in the first hour of trading for the GLD, finished down about 1%. So the chart looks a lot worse than the actual numbers are. It's down about 1%, silver down about 0.5%. Big mover was copper. Copper actually spiked higher on comments from President Trump. The CPER, which is the copper ETF that we track, up over 8% today. Copper-related stocks like Freeport-McMoRan up pretty good. I don't think I grabbed that chart now that I'm thinking of it, but when we get to the market recap, mental note, I'm actually going to write it down. I'm not great with mental notes. Those tend to just go away. Notes written down on a notepad, much better. I'll do that, and we'll talk about FCX when we get to the heat map here. Energy stocks up a lot more than you'd think, given the fact that crude oil was up a bit today, but you'll see the charts here in a little while. Looking at the cryptocurrency markets, super excited. I think on Thursday of this week, episode of the Market Misbehavior podcast, I'll be catching up with Adrian Zadunchik. Adrian was an early crypto adopter, grew a fantastic community of crypto traders, which he still runs to this day, among other things. I've interviewed Adrian a number of times over the year. He's a CMT, which means he understands the technical analysis toolkit quite well. And also understands the cryptocurrency markets better than you and I do. So I thought that would be a great guest to bring on. Just talk about the crypto environment as Bitcoin, attempting to break to new all-time highs, but really failing to do so in May and June, and now into July. We'll see what his take is overall. For now, all of the top 10 cryptos tracked on the stock charts platform in the green. Bitcoin up about 0.5%. We're just below 109,000. Ethereum prices just above 2,600. And I own both of those in my own accounts. GLD as well, out of all the things we've talked about. All right, looking at the sectors, more down than up today. You can see 4 of the 11 S&P sectors were in the green. Energy was the biggest story, with the XLE up 2.7%. Materials second, up 0.8%. Technology and healthcare basically tied for third, up about 0.5%. Everything else was down today, not by much though. The utilities and consumer staples sectors both down about 1%, about the same for financials. Financials are interesting, right? If you look at the last month, technology and financials have kind of been the juice, right? Those have been the two sectors which is quite a lot of strength being demonstrated in a number of sectors, or a number of stocks in a number of groups within those economic sectors. Some of the financial stocks pulling back pretty good, though, this week. I grabbed one of those banks, and I forget which one I grabbed. We'll look at it a little bit later, but a lot of those stocks very overbought, now coming back a little bit. Semiconductors still kind of holding up pretty well, right? So technology remains the strongest sector, I would say, by far. Looking at the breadth data, a little bit better today. Yesterday's breadth data was not particularly strong. Today, you can see on the New York Stock Exchange, which is that top line, 60% up, 36% down. So those are decent numbers. Small caps, the best breadth was 71% of the S&P 600, up 28% down. So overall, breadth better today. And the S&P almost neutral, right? You can see the shading here is more neutral. Only 53% of the S&P 500 members higher. I think the biggest risk to this market, to be totally honest with you, probably less breadth, but more of the Magnificent Seven names, because a number of these, as we talked about on yesterday's show, charts like Alphabet aren't great at the moment. And what's happened is they've failed to break out. Now they've kind of stalled below previous resistance. So there's just not a lot of upside follow through on some of these charts. Having said that, Tesla finally having a decent up day after getting clobbered yesterday, coming out of the holiday weekend on news of the new Elon Musk third political party announced. Tesla bouncing back up about 1.3%, still down at the lower end of the range here for the last couple months. Nvidia up another 1.1%, Meta up about 1/3%. On the downside, you can see Amazon, Alphabet, Netflix all down over 1%. Again, not end of the world kind of moves, but not great. We'll look at the chart of Amazon a little bit because the golden cross, which loves in the financial media, people love to bring that up because it has a great name, to be honest with you. Death cross, even better for grabbing headlines. But the golden cross, when the 50-day crosses up through the 200-day, as you'll see on the chart, not my favorite trend following mechanism I could come up with for you, but certainly something that gets some attention. So we'll take a look at what that might mean for Amazon. All right, I do see some more questions coming in. Thanks so much for popping them in. We're going to go through the heat map, go through some charts, and then I will take a question or two before we wrap for the afternoon. And if you're watching the replay, as always, just put questions in the comments section on our YouTube channel. We love to review those questions. I respond to every comment that comes into my YouTube channel, whether you realize that or not. I found it to be a great way to just have a good dialogue with those of you that watch the show. I've learned a lot from questions that you guys ask, and I appreciate it. So happy to take the time to at least give you a quick response back, and if not, discuss it further on the show. So thanks for keeping it interesting for sure. All right, looking at the heat map, today I was drawn to two things. The green over here in the energy sector, the red over here in the financial sector. Let's start there with some of the things showing some weakness. The big financial stocks, particularly banks, Bank of America, JP Morgan. If you look at the top 5 stocks in the financial sector, the biggest one is Berkshire Hathaway. And to be honest with you, it's not really a financial stock. I mean, it's sort of a 12th sector of its own, probably. I mean, it's a conglomerate. And there are a number of kind of conglomerates within the S&P 500 that really, it's hard to bucket them in a particular sector. Like Disney's one of those. It's really more of a consumer name, but it is kind of a, media company, right? Of course, with a lot of holdings there. So it's bucketed in communication services, but pretty diverse business. And I think you could make that case for a number of the stocks that you see listed here. Berkshire Hathaway, though, is one of the weird ones. I mean, it's a holding company, to be honest with you, that holds a bunch of consumer stuff. It's a bunch of consumer staples in there, like Coca-Cola. But it is still technically in the financial sector. So that's the biggest one. Number 3 and 4 are Visa and MasterCard, which, again, kind of, non-traditional financial stocks. These are more payment processors, credit card companies, et cetera, which means only 2 of the top 5 stocks are actually like traditional financial institutions as we would normally think of it, JP Morgan and Bank of America. And those are the 2 that are down pretty good today. So the good news is both of those are coming off of new all-time highs in the last week. The bad news is they're all coming down pretty severely after becoming overbought, and in some cases quite overbought going into the holiday weekend and coming into to this week. So overextended names quite far from their moving averages, which is something we'll come back to a little later in the show today. So again, big financial institutions not looking particularly good today. Overall, trends still quite constructive. Other observations I would make: a weakness in the big box retailers. You can see the top 5 stocks in the consumer staples sector are all down. Now, the first 2 are those big box retailers, Walmart and Costco. Target is usually bucketed with consumer discretionary. So it's actually over here. Where is it? Never try to find an individual stock on the heat map. That's the lesson I just learned today. It's on here somewhere. In the meantime, the 2 big box retailers you see here, Walmart and Costco, both in the red. Walmart feeling the most pain, down about 2.25%. But you can see all top 5 of the consumer staples stocks are in the red. One of my favorite ways of analyzing offense versus defense: look at the performance of the consumer discretionary sector versus consumer staples, and that's been over the years a really helpful way. There's Target. I found it down there. It's been a fantastic way of really thinking about how investors are rotating to more offensive, to more things you want versus defensive stocks, things you need within the consumer space. It's been a great way over my career of thinking about relative positioning and how investors are rotating their assets. For now, because these names are so big in the consumer staples sector, it's really making that ratio look a lot more like consumer discretionary is working over consumer staples. So that ratio is still very much favoring offense over defense. We highlighted that, I think, on yesterday's show, the equal weighted version of that ratio doing remarkably well. Utilities in the red as well. So you can see a number of the defensive sectors still underperforming, still underwhelming. Again, one of the things I look for when a market is in a position of strength, which I would argue it still very much is from a technical perspective, you look for signs of weakness. You look for divergences. You look for weaker breadth, weaker momentum. You look for improvement in defensive sectors, which would indicate often is sort of a great sign that investors that have been riding the offense up are starting to get more defensive. They're getting nervous about the market rotating lower. So they start selling some of those gainers and start rotating into defensive sectors that have usually been underperforming. That usually makes this sort of alligator jaw effect where the top sectors start to rotate lower, the underperforming sectors in the defensive areas start to improve. We're not seeing that yet. And I would say today, reminding you, we're not there, right? Defense is still underperforming offense. That's been a theme that has been the case here really for a little while coming off the April lows. All right, so what has been working? I'm actually noting some random things in the technology sector as always. A number of the semiconductors looking pretty good, like Micron, Applied Materials, AMD. I would say within the healthcare sectors, I'm looking at Charles River up about 3% today. Biogen, again, still, I think more to prove. These are charts like Biogen is still not a great chart if you look over the last 12 months, but now making a bit of a higher low, now starting to rotate higher a little bit. So you have, the reason why a Biogen looks so interesting here is because we have so many other stocks that kind of look flipped over, that have had really good runs and maybe starting to roll over a little bit. And the question is, do you see assets rotate into a Biogen? What would it take for a Biogen to look like a great chart? I think more, right? We're making a higher low, so that's good. We're bouncing off of the 50-day moving average in blue. That's good. Paul Tudor Jones' famous quote, nothing good happens below the 200-day moving average. So I think a chart like this over 150, completing that rotation to more of an accumulation phase, much more powerful. If you do take a position here, if you're a little more aggressive, I don't blame you. I would be thinking about that recent low. That's where I would be locking in any sort of or minimizing any sort of losses. That's where I would sort of automatically put a stop at that swing low. So if you're buying here today, you're basically betting on a recovery and you're limiting your downside to that previous low. The RSI held 40 on these recent pullbacks, which is encouraging. It certainly feels more like a bullish rotation than anything, but still more to prove, I would say. For me as a trend follower, I want that trend to be a little more developed before I start to get behind it. I did make a note, and as promised, we'll look at Freeport-McMoRan. Copper stocks overall doing quite well. Freeport-McMoRan, FCX, is one of the names that is good stock to just think about as sort of a relatively pure play on copper. What's interesting about the chart of FCX is we've had a really good run off the April low, higher highs and higher lows, depending on where you draw the trend line. I mean, this is kind of an easy trend line to draw. You take the April low, we connect that to the June low. If I own a name like this, I'd probably be watching that trend line. As long as we hold above that trend line as days and weeks go on, pretty good position. Note how the trend line lines up really well right here with the 21-day EMA, which I feel like over my career, I'm starting to appreciate more and more as a short-term kind of tactical level of support. We had a number of pullbacks to the EMA. The 21-day EMA, they're almost identical levels currently around 42.50 to 43. I think that's what I'd be watching on a chart like this. And the way that you can sleep at night, if you have a position like this that's starting to gain, draw a trend line like this, watch the 21 DMA, and just wait for a break. And until and unless it hits that level of support, chart's pretty good. And as a result, because of that big move higher, we're starting to see the relative strength make new 3-month highs, which is encouraging as well. I'm going to add that to the list here, even though I didn't, but I'll do it now. All right. What else on the market carpet? I think that's it. I mean, at a high level, which is where I usually start, kind of a mixed day, right? I mean, the breadth was sort of, while the breadth was technically more positive for the broader New York Stock Exchange, the S&P 500 breadth was almost even between advancers and decliners. That's kind of what the heat map looks like to me. I'm seeing sectors like financials and consumer discretion or communication services not particularly strong. Seeing sectors like energy, healthcare, technology much better today. Keep an eye on those for sure. All right, shall we look at the charts? And again, thanks for the questions coming in. We'll get to those here in a moment. Before we do, let's look at some charts together. I updated before yesterday's show this daily chart of the S&P 500. I think of the chart of the S&P. If most of the charts I show, I try to keep them super clean because for me, I've spent a lot of my career putting charts in front of people that are not super chart oriented, and so I try to make them as clear and understandable and relevant as possible. And I think one of the great mistakes you can make as a chartist or as a technical analyst is to overcomplicate and have a bunch of lines and things. The moment you put something like that and you see someone's eyes glaze over, you've lost them in terms of whatever point you were trying to make with the chart. So I would always coach technical analysts just getting started, keep it super simple. And if any line or color or point doesn't help your case, just get it off of the page. Having said that, the daily chart of the S&P 500 is one of those where I always make an exception because I look at this chart many times a day. It's one of the first charts I look at every morning. I think of this chart as an ongoing discussion I'm having with the markets about what I'm seeing, what I'm feeling, how what levels are important, what levels are meaningful. And it's a great way I can look back on this chart for years and just see what was I thinking at a certain point and why. I would encourage you to think of the daily chart of the S&P in a similar fashion. It's been quite helpful for me over my career to do so. So what levels stand out right now? Well, similar to the chart of FCX, we see the S&P 500 has had a number of pullbacks to an ascending 21-day EMA, most recently in mid-June. We're well above that level. And I think as long as we hold that level on a pullback, I'm not concerned at all from a technical perspective. I have plenty of things that I could tell you that concern me about the macro environment. But again, from a technical perspective, markets are strong and we're making higher highs and higher lows. That's the basic assessment. If that 21-day EMA would fail to hold on a pullback here, other levels I would look at. I think this gap higher, which was from late June, could be meaningful. That's around 60.50. I think the swing low from mid-June is an important one as well. That's around 59.50. That's about where the 50-day moving average and not too far above the 200-day moving average is as well. So we've got a number of support levels below current levels, and that's often what you have after a big run higher. You have some really clear-cut support levels below the current price action, which means it gives you a really good sense of where a pullback could come to, and what sort of breakdown would tell you to be a little more concerned. So first things first, the S&P over the 21-day EMA is a strong chart. We're just coming out of that overbought region yesterday. So we'll see if there's further pullback. But for now, that's the level just above 6,100 that I'm keeping an eye on. It's just an initial gauge of a pullback phase. The McClellan oscillator, as you see here, remains above zero. This is not updated for today's close, but given the bounce in the AD line, I would expect this to come up a little bit. Probably not go much lower today. But again, when you think about warning signs, right? When the market is strong, when we're in an uptrend phase, look for the McClellan oscillator to break below zero. It's not an end of the world indicator. This is a short-term measure of breadth, but it tells you something's different, right? When the market's in a position of strength, when we're breaking out to new highs, you usually have the McClellan oscillator above zero. That's why we follow it. But when we break below zero, that's often a sign that things are starting to change. And whatever, optimism, whatever sort of bullish support that was causing prices to go higher has changed, right? And we're starting to see more distribution. And that's often what happens at the beginning of a pullback phase. So for now, we're okay. I'm watching to see if and when, really more when, that would break below the zero level. And for now, we're okay. Keep an eye on that one through the course of this week for sure. All right, the rest of these, some individual charts that I wanted to share with you. Amazon is one of those because we have the golden cross. The golden cross is a widely followed phenomenon when the short term, and it really is more of a general point of view when you have two moving averages, the short term and the long term. And when the short term crosses up through the long term, that's called a golden cross. When the short term crosses down through the long term, it's called a death cross. Most often, this is used in reference to the 50-day and 200-day simple moving averages, which is what you see here with the blue line as the 50-day and the red line as the 200-day. So today, we have what's called a golden cross, where the short term crosses up through the longer term. So when you hear golden cross, you're probably thinking that's awesome, bullish sign for Amazon. You don't have to look that far on this chart to see that that's really not that great of a trading system. So the last time we had a death cross where the 50-day crossed down through the 200-day. So that should be the opposite, right? That should be a pretty negative sign if the 50-day crosses down through the 200-day. I mean, that's right there, right? That's on April 22nd, which was arguably a really fantastic time to buy Amazon, because soon after the low was confirmed and the market started to go higher, which is where we are today. The problem with the 50 and 200-day and using those as a system is it really does not test very well on most things. And again, it depends on the nature of the price action. If you have a really long-term uptrend, it tends to be quite profitable. But in this sort of choppier environment, it's almost like you want to do the opposite. Death crosses are often good times to buy because the short-term price action has gone so much lower that we're sort of getting to the lower end of the range. And when you have a golden cross, is usually more the time you want to sell because the market has gone up enough that the short-term moving average is above the upper term. So not, the fact that a golden cross happens on Amazon, you will not hear me ringing the bell saying great time to buy Amazon. I'm more skeptical in this environment. I'm thinking more about the divergences. I'm thinking more of, seeing if the 21-day EMA holds as it did in May and as it did in June. It's getting very, very, very close here. Wanted to also highlight, this is a great, Amazon's a great chart showing you why Fibonacci retracements are part of my process. If you take the February peak and the April low, 38.2% of the way up was that initial rally off of the April low before we sort of retested it. We then once again bounced up to the 38.2% level. We gapped above it and stalled out at the 61.8% level before pulling back to the 200-day. Those Fibonacci levels more often than not just give a really good framework. Is what I tend to think of it as a Fibonacci framework. Some key levels to keep in mind. Think about what it means if a stock is able to break above one of those levels. The general idea is if you break above the 38.2% level, you most likely go to the 61.8% as a next objective. It's worked pretty well on Amazon. The reason why I'm talking about it now is as long as we stay above 211.50, we'll call it, we're still above that last Fibonacci support level. If we would break below it, though, that would be a negative sign suggesting further retracement. So I think still an important one to watch. I mentioned semiconductors earlier. Again, technology is in a class all its own. When you look at the 11 S&P sectors coming off the April low, it's been the place to be. The relative performance has been, remarkably better and significantly better than any of the other 10 economic sectors. The argument against something like semiconductors is it's already gone up a ton. As a trend follower, I'm not a huge fan of that argument because I'm going to follow an uptrend as long as possible. I will never forget going into a Fidelity portfolio manager's office early on in my career there before I knew better, and a stock had an incredible rally. The portfolio manager had a decent position. I went in there saying, hey, it's gone up a ton. We probably should lighten up. And he said, I'm not touching that thing. This is my best position. Clients love that I own it. I love that I own it. I'm going to hold this on as long as possible until the market tells me not to own it anymore. And that was really probably my initiation into the brotherhood of trend followers, recognizing the value. And again, over time, I've learned how well that can create value and help you just participate in the big up moves in equities and ETFs. So for now, I think a chart like this, you go into trend following mode, use things like the chandelier exit system, which we've talked about on the show a number of times, the 21-day EMA. Those are the kind of levels that follow the price higher. And as long as we hold that on pullbacks, it's still good. We start breaking those kind of things, that's when you want to revisit the position. So I guess I always think of it as let the chart tell you it no longer deserves a place in your portfolio. Until then, charts like the SMH are pretty constructive. Now, we are seeing some pretty good breakouts in the energy sector. Here's the chart of PSX, Phillips 66. You can see the chart finally breaking above the 200-day moving average. This is one of those charts that shows, in my opinion, just a great example of why, waiting for a significant or if not a valid break above the 200-day it tends to pay off, because these little times when we pop above it, but then immediately come lower, there's not enough follow through. But then that changed here in mid-June with a break above the 200-day, then a retest from above, and now we're resolving to the upside. The divergence that we picked up here starting to be negated by the fact that we're breaking out on higher momentum. Hess is another one in this group of integrated oil companies. breaking above the last Fibonacci resistance level. Here you can see the 38.2% level held, finally broken here as we broke above the 200-day in June. We went right up to the 61.8% retracement. A bearish engulfing pattern brings us right back to the 38.2%. And today we appear to be breaking above it. So we'll see if there's a follow-through day tomorrow. But overall, I'm impressed with the breakout I'm seeing on some of these energy stocks. I've avoided looking at energy as a legitimate technical play because crude oil prices have been been relatively weak. We really haven't seen that follow through on crude oil prices after the noise that we had around the conflict in the Middle East. But for now, the charts are getting more and more constructive. I drew some purple lines on here. These are called accelerated trend lines, which is where you have an initial trend line and then the price gets really far away, so you draw an additional one. It's helpful when the market starts to kind of go up exponentially. Trend lines become less and less relevant if the price is way up here and the trend line's way down there. Like, you don't want to wait that long to have a trend line trigger. So what you do is you draw trend lines of increasing slope, and just the most recent trend line is the one you want to be holding on to. So if we get more of an acceleration, maybe we draw one more accelerated trend line. But for now, it's holding above trend line support, having a nice upswing. I mentioned the big banks coming down in the financial sector. Those were the red boxes you saw in the on the heat map in the lower left corner. Again, JP Morgan is 2 days off of a new all-time high on Thursday. Coming out of the holiday weekend, we have a bearish rotation yesterday and a bearish follow-through today. Still above the 21-day EMA, still above the 50-day EMA, still above the first Fibonacci support level, which is here around 260. I think holding those levels on a pullback is still a good chart. We break below 260. I wouldn't have a stop much below that. For me, that would be the get out of the way type of signal. I don't own JPM directly, but if I did, I would be looking at those levels of support to see if they're able to hold or not. So for now, still a bullish trend of higher highs and higher lows. Watching the 21 DMA as an initial, or EMA as an initial level of support. Royal Caribbean's the last chart we'll look at, individual name before I take a question or two. This is a chart that came from one of my premium members. Sent a question related to this indicator. Asked about, does it make sense to look at how far the price is from different moving averages? And my response was absolutely, right? This is an indicator called PPO. This is actually the indicator I use to build my market trend model. It's basically just a series of the PPO indicator, which is the percent price oscillator. And on stock charts, what I'm doing here is basically just saying, where is the daily close versus the 21-day EMA? The little zero there means it turns it into a histogram, which I think looks pretty, and it's easier to make sense of. So this is basically showing me on this y-axis here where we are in percentage terms relative to the 21-day EMA. We're currently on this stock about 12% above the 21-day EMA. I can see the last time we tested the 21-day EMA was there the second week in June. So you can see it hits the zero level. It's based on the closes. So you can see it's a little above here when we tested it. So look at where we're at and look to the left, and you can see that every time Royal Caribbean is about 10% above its 21-day EMA. That's where we often have had a bit of a pullback. And that's where I find an indicator like this can be quite helpful. It's not the most perfect trading system I've ever seen, but that feeling when a stock has had a rally and all of a sudden it feels like it's gone too far, too fast. We often do an analogy of leaning too far over your skis. And if you've ever done some downhill skiing, that means you're leaning way too far. You need to sort of lean back a little bit. And that's what this chart is suggesting. So this is an indicator looking at percent above the exponential moving average. You can do the same thing with simple moving averages. I think with a chart like RCL, it's pretty good at showing you how far is too far before we often get a mean reversion. It may not mean that the long-term trend is going to change, but it may just mean that on that particular day, maybe it's not a great day to take a new position. Maybe it's better to wait for a bit of a pullback and an opportunity to buy on the dips. There are a number of charts that look kind of like RCL. A number of the banks looked like this just before the pullback that we've observed this week. So an indicator to keep in mind on it. That's called different things on different platforms. Stock charts, which is the platform I use primarily now. There's an indicator on stock charts ACP called distance from moving average. I think that's what it is. and you can do different types of moving averages and do multiple ones and all sorts of cool stuff. So there you go. All right, shall we take a question or two? I would love to do so. Let's see. Saw a question on Berkshire that looked kind of interesting. Okay, Akira, thanks for watching, my friend, as always on YouTube. Dave, like you, I own Berkshire Hathaway in my retirement fund. Agreed, and I do. I own the B shares. The BRK continues to go down. What signals and points we should pay attention to in the BRKA and BRKB shares? Yeah, so the Berkshire Hathaway is one of those. I'll say annoying, just because multiple share classes just make things a little more complicated than I feel like they usually need to be. But Berkshire Hathaway has multiple share classes. The A shares are sort of the original shares, and the problem is they're currently trading at $715,000 per share, and so these were really designed for institutional investors. It's never been split. I'm Warren Buffett, proud to never really split, never pay a dividend, just kind of reinvest the proceeds back into the holding company, and as a result, it's ballooned to this crazy value. And the problem is, a lot of individual investors may not have space in an account, or may not have the capital to drop $715,000 on one share of stock. Now, in the days of partial ownership, that's probably less of an issue, but that is why B shares were issued with some adjusted voting rights, and it's trading more around $500 a share. And back when it was issued, it was a lot lower. I own a bunch of this in a retirement account as a long-term holding. I'm not planning to change that. However, I like you, Akira, have definitely noticed the fact that these two charts that I just brought are starting to go down. I would say from a technical perspective, it really doesn't matter which one you look at. The shares track each other very, very well. I usually look at the B shares because that's what most clients I've worked with have ended up owning. But the patterns are very, very similar. Some multi-share classes look a little more different, but this one really does not. I think it's interchangeable. Similar to like Alphabet in that way. There's not a lot of difference between the multiple share classes that are widely referred to. Having said that, breaking below the 200-day moving average is a bit of a concern for me. The moving average is all starting to slope downwards is another one as well. If I had this in more of a trading account, I probably would be out by now, because this feels like more of a tactical downtrend for sure. And the fact that we're now breaking below the 200-day makes me feel like it might be something a little broader. The other thing that concerns me on the chart of Berkshire Hathaway is the momentum, right? If you look at the RSI, we kind of got down to 40, but then we haven't been above 50 since the end of April. So there was this gap lower, which now looks very much like a breakaway gap, right? An initial gap in the downward move. And then we've just seen continued deterioration here over the last, 2 months. So from a technical perspective, not a good chart. Breaking below the 200-day, I think, is dangerous. The relative strength declining is another issue, because this is happening while the major benchmarks are going up, and most stocks are sort of making new swing highs. So the chart of Berkshire less ideal. For me, I think the relative strength is the biggest concern, because what that shows you is that by owning Berkshire right now, you're not owning a bunch of other things that are probably looking a lot better. And so there's the opportunity cost of owning Berkshire versus other things. I probably won't change my current position because it's in a retirement account. I'm not planning on touching that for a while. But if I had more of a trading account where I was more actively managing risk and positions, I'd probably be at least reducing the position at this point, given the breakdown below the 200-day moving average. Thanks for asking about that, by the way. All right, Skip, thanks for watching on YouTube. I haven't seen your name with a question before, so I'm happy to take it today. Target is in consumer staples, which indeed it is. Toward the bottom, small, medium, rectangle. Yes, I got there. It just took me a while. Up 0.4% today. Was it previously in discretionary? How are the buckets chosen? Oh man, this could be a whole day long, offsite event. How these things are done. Here's the story, right? Long story short, stocks are determined to be in particular sectors by the S&P 500. They have like an official, they have a group that sort of assigns them. But anyone who's been an institutional investor, they're all imperfect, right? And a lot of stocks like big box retailers. I mean, if you look at Costco, right? I mean, I don't know about you. I'm not a Costco member. My parents are. I just spent a week with them. So we talked about Costco at one point. They listed out, I asked them about Costco, like what they actually did there, and the number of things that they buy that I would not categorize as consumer staples is a pretty decent number, right? Because at Costco, you're buying toilet paper and Windex and things, but you're also buying tires and televisions. And they, I mean, I'm sure at some point they've probably done a lot of holiday shopping at Costco. These are more consumer discretionary type of things, right? I mean, the whole point is it's sort of literally, it should sort of be in this like this weird limbo between the two sectors. So, so the short answer is these stocks are assigned to sectors. Most institutional investors love to complain about how different stocks are bucketed, and certain things like solar stocks are kind of technology, they're kind of energy. With platforms like stock charts, we would actually just move stocks between different sectors if we disagreed with them. So, solar stocks are under the technology sector. Alternate energy, stocks could arguably be in the energy sector. You could make an argument for that. Are solar stocks more of a utility, right? It's an energy but electricity producer like other things. Does that make sense? It's so imperfect. And so the short answer is the sort of index providers all have their own systems. Here in the U.S., the S&P 500's industry classifications, which is called the GIC system, is the most common. So that's the 11 S&P sectors that you see here. And the ETFs, the sector spiders, are linked to those S&P sectors. But in Europe, like the Russell sector classifications are much more possible. A number like Bloomberg has their own, which they try to promote on the Bloomberg platform. So it is a source of great debate in the institutional community about where different stocks should be bucketed. We would often reclassify stocks because we thought they made sense in a different sector for some reason. It's a very imperfect science. So that was a long-winded way of saying big box retailers all used to be in consumer discretionary. And at some point, I forget when that was, they were all reclassified into consumer staples. So randomly, as I'm going through and looking at charts, I randomly expect Target to be in the consumer discretionary sector because that's where it used to be. And now those, I'm now remembering, of course, they're all in consumer staples. But again, I don't think many of us will ever agree on where different stocks should be. It's one of those great water cooler discussions you have when you're working at a big money management firm, I guess. Having said that, thank you guys so much for the thoughtful questions. There were a number I wasn't able to get to. I will put them in the mailbag. We're planning an all mailbag episode on Friday of this week. We'll be excited to share some responses with you. Keep the great questions coming here during our live stream, or just put it in the comment section below the video on our YouTube channel. We appreciate that so much. Don't miss the last couple episodes of our Market Misbehavior podcast. Callie Cox of Ritholtz Wealth Management was an awesome guest. Mike Webster, Webby from Investors Business Daily, a fabulous guest. Great investment wisdom. He's a smart and humble investor. I would encourage you to check out those recent interviews. We got 2 more slated for the rest of this week. So more good things to come. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.